Marcus ran a small business in Chicago, international transfers, families sending money home. His Chase account was 7 years old. Never a missed payment. Never a call from the bank. Never a question. One Tuesday in November, he got a letter. 30 days, account closure, no reason given. His client's money was in transit. Payroll was scheduled for Friday. He had $34,000 in that account that he could not move. He called the bank, then called again, then went in. Nobody could tell him why. Why does this happen? Who decides? And could it happen to your account? Marcus thought it was a mistake. Most people do. In 2025, U.S. banks accelerated what the industry calls de-risking, not for fraud, not for crime, for pattern, for what the system decided an account looked like. In 2026, the closures are still accelerating, and the people receiving those letters had no idea how closely they were being watched. Every bank account has a risk profile, not your credit score, something separate, something most people don't know exists. The bank's system assigns a score based on behavioral patterns, transaction speed, cash flow timing, the rhythm of how money moves. When that rhythm changes, or when it doesn't fit a profile the system considers normal, the score updates. Cross a threshold, review. Cross a higher one, closure. Marcus moved money internationally in irregular amounts on behalf of other people to the system that looked like something. It didn't ask what it actually was. This system didn't start in 2026. It started in 1970, a federal law. Banks required to monitor and report unusual financial patterns. At the time, unusual meant something specific. Human reviewers, physical files, cases reviewed one by one. Then banking went digital, then real time. Then the volume outgrew any team of humans. So the process automated, and the definition of unusual expanded. By 2026, the system is not looking for criminals. It is looking for patterns that don't fit what it was trained to expect. Marcus didn't fit. What exactly did the system see? And what did it do with what it found? Before Marcus got the letter, a file existed. Not at his branch. In a compliance system he had no access to. It contained his transaction history, not as he understood it, but as the model had categorized it. International transfers, variable amounts, multiple recipients, irregular timing, each one individually, unremarkable. In sequence, the system read it as a pattern. Specifically, it read it as layering, moving money through multiple accounts to make it harder to trace. That's what layering is. That's what the model was trained to find. Marcus wasn't layering. He was paying rent for 6 families in 3 countries. The model saw the same shape. It doesn't read the reason. The file built on Marcus's account didn't know any of that. It knew the shape, and the shape crossed a threshold, which is when the process moved to the next level. The file may also contain a federal report. It's called a suspicious activity report. Once filed, it goes to federal systems, the Financial Crimes Enforcement Network, U.S. Treasury. Marcus cannot request it, cannot confirm it exists, cannot see what it says. And the bank is legally prohibited from telling him. The law is specific. A financial institution shall not notify the person involved. The reasoning, if someone is under investigation, telling them could interfere. But the system files first, then, sometimes, it reviews. Marcus wasn't under investigation. He was running a legal business. The system didn't know the difference yet when it filed. Nobody at the bank reviewed Marcus's file first. A model did, trained on millions of transactions, flagged and unflagged, criminal and legitimate, over years of data. It doesn't read context, doesn't know that the money going to 6 different accounts in 3 countries is rent for 6 families, not layering. It measures deviation, pattern versus expectation. The model calculated. A compliance officer received the output, reviewed it, signed the closure. Marcus's 7 years meant nothing to the model. Relationship isn't a data point, it was trained to wait. The system has stopped real things. Fraud networks, laundering operations, terrorist financing. That is documented. The system was built for that, and parts of it work. But it was built for a narrow target and deployed at total scale. Every account, every pattern, every deviation from expectation. The question the bank cannot answer, because no law requires them to, is what percentage of those closed accounts belong to people like Marcus? People who were irregular, but not wrong. That number is not published. Nobody is required to publish it. The threshold moved while you were sleeping. International money transfer businesses, like Marcus, cryptocurrency companies, legal ones, operating in compliance, religious organizations, nonprofits, small legal cannabis businesses in states where it is legal, individuals who received large irregular deposits, an inheritance, a home sale, a lawsuit settlement. In November 2025, the CEO of a major crypto payments company posted that his bank had closed all his accounts. Without cause, without explanation. The post went viral in hours because he wasn't the only one. By August 2025, the issue had reached the White House. An executive order signed, aimed at ending what was now being called politically motivated debanking. The bank said their decisions were risk-based, not political, not targeted, just the system doing its job. The system doesn't know the difference. The system Marcus encountered was not static. In 2026, the models are adaptive. They don't use fixed cutoffs anymore. A pattern that was unremarkable last year may not be this year, because the model updated, because the baseline shifted, because what the system considers normal changes on its own schedule, without notice, without publication, without any requirement to tell you what changed. You are being evaluated against a standard you cannot see, and the standard is moving. Marcus's account was 7 years old, 7 years of behavior that fit the model at the time. When the model updated, his pattern read differently. He didn't change. The threshold did. A bank account is not a convenience. It is infrastructure, the center of a financial life, payroll, client payments, rent, utilities, transfers, everything connected to it. Lose access to that center, not for fraud, not for crime, but because a model generated a risk score, and the connected systems don't know why it happened. Marcus's clients couldn't receive their transfers. His employees didn't get paid on time. His suppliers put him on hold. None of them were told why. Because Marcus didn't know why. Here's what you can see, and here's what exists in the same system. No interface for the second column, no notification system, no window to check. You find out when something fails, when the letter arrives, when the transfer doesn't clear, when the banker on the phone says there's nothing they can do. Marcus found out on a Tuesday. Marcus spent 4 months trying to find out what triggered the closure. He wrote to the bank, filed a complaint with the CFPB, contacted his congressman's office, hired a lawyer. The bank sent a form letter. The complaint produced a form letter. The lawyer found a wall because the bank has no obligation to disclose the specific reason. If a SAR was filed, they cannot confirm it. If the reason touches on compliance monitoring, they are legally protected from providing detail. He was running a legal business. He knows that. What he doesn't know, what he cannot know, is what the model saw. If this has happened to you, a closure, a restriction, a hold with no explanation, most people describe the same experience: a wall with no door. Banks are not the only system running this way. Payment platforms, fintech apps, transfer services. Each runs its own risk models. Each sets its own thresholds. None publishes them. In 2026, the models are tightening. De-risking sweeps are accelerating, and the pool of account behavior that reads as irregular is getting wider. The executive order signed in 2025 said it would end politicized debanking. What it cannot do, what no executive order can do, is reach inside the model. The model is not political, it is not targeted, it is not malicious. It is a system that was trained to find patterns and finds them in everyone's account, every day, in real time, against a threshold that is moving. Marcus opened a new account at a smaller bank. He rebuilt his client relationships. Most stayed, some didn't. He still doesn't know what the model found. He still doesn't know if a federal report exists with his name on it. He will probably never know. The account looks normal now, the new one. But the file, if there is a file, is still there, in a federal system that he cannot access, that nobody told him about, that has no obligation to tell him anything. So the question isn't whether this happens. The question is simpler than that. Does your account look irregular to a model you've never seen? The model that closed Marcus's account runs on a score. The score has a name, and it's assigned to your account right now. That's the next video.